VA funding fee is money charged to the veteran by the Department of Veteran Affairs for utilizing the VA loan. Collecting this fee ensures that the costs of the VA Home Loan Guarantee Program are not transferred as a burden to U.S. taxpayers. The funds gathered from all VA loan transactions are combined into a pool, which is then utilized to cover claims made by lenders in cases of default. Some important bullet points about the VA funding fee. The funding fee is not a flat dollar amount, but always a percentage of the loan amount. The funding fee is set by Congress and doesn't change very often. At the time of this recording, here are the percentages. Always check the VA website at va.gov and under the section named Housing Assistance for the most up-to-date percentages. The funding fee is based on the loan amount and down payment expressed as a percentage of the lower of purchase price or appraised value. If the veteran is putting down 20% of the purchase price, the loan to value is 80%. The funding fee percentage on any given VA loan is dictated by any combination of 5 factors. A. Whether the veteran is in receipt of VA compensation for disability leading to exemption from the funding fee. B. The amount of the down payment compared to the lower of the appraised value or purchase price. For example, for a veteran putting down 5% of the purchase price on a $400,000 home purchase, at the time of this recording, the VA funding would be 1.5% of $380,000, which is $5,700. If the veteran only has partial entitlement, the down payment to cover a shortage for lender's guarantee requirement purposes is also considered as a down payment and can reduce the VA funding fee. C. What type of transaction the VA loan pertains to. Example, purchase or cash out refinance, IRRRL, VA loan assumption, etc. D. Whether it's a joint VA loan or not. Examples of joint VA loans are where a veteran and non-veteran, not the veteran's spouse, purchase the home using a VA loan together, or 2 unmarried veterans do so. E. Whether the veteran is using their entitlement for the first time or for subsequent use, example, second or third time, etc. The VA funding fee is charged one time up front for any transaction, but there's no monthly amount such as FHA's mortgage insurance premium, for example. The amount of the VA funding fee can be divided among different parties. For instance, on a $300,000 loan with a $4,500 funding fee, the seller might pay $1,500, the veteran another $1,500, and a credit from the lender could cover the remaining $1,500. Contrary to the belief of many lenders, the VA has no objections to dividing the funding fee in such a manner. Until VA has received from the lender the money for the funding fee, they generally won't apply the VA guarantee on that loan. If the lender inadvertently doesn't remit the money to VA, an unfortunate situation could arise. The veteran begins to make their mortgage payments on time, but when they try to do an IRRRL refinance, they won't be able to, because an IRRRL can only be done if you're moving from one genuine VA guaranteed loan to another. The following veterans are exempt from paying the VA funding fee when they obtain a VA loan. A. A veteran who is receiving disability compensation, or who, but for the receipt of retirement pay or active service pay, would be entitled to receive compensation. There are instances where a disability rating is 0%, yet the individual receives benefits equivalent to a 10% rating. For example, a woman who undergoes a hysterectomy while in service is deemed 0% disabled, as this does not result in physical limitations. However, due to the loss of reproductive capability, a disabling factor, she is granted an award corresponding to a 10% disability rating. B. A surviving spouse of any veteran, including a person who died in the active military, naval, air, or space service, who died from a service-connected disability. C. A veteran who is rated eligible to receive compensation as the result of a pre-discharge disability examination and rating, or based on a pre-discharge review of existing medical evidence, including service medical and treatment records, that results in the issuance of a memorandum rating. We discuss this in detail in another video. D. A member of the armed forces who is serving on active duty and who provides, on or before the date of loan closing, evidence of having been awarded the Purple Heart. If the Certificate of Eligibility COE shows non-exempt, the lender is instructed by VA to check with the veteran if they have a pending disability claim on file with the VA. If there's a pending claim, the lender should get an updated COE before the loan closes, ideally within 5 days of closing, to see if the borrower qualifies for exemption. This is discussed in detail in another video of ours. Borrower refunds. If a veteran borrower pays a funding fee but shouldn't have because they were exempt, and the VA decides they should get a refund, the VA will give the refund directly to the veteran borrower. In these situations, lenders don't need to lower the loan's principal amount. The funding fee on a transaction involving a VA loan might have been collected a few different ways, including cash funds from the veteran, seller contribution towards closing costs, or rebate credit from the lender, etc. Since VA updated its rules in 2019, irrespective of how the funding fee was collected, if the veteran is eligible for a reimbursement for any reason, the refund is paid directly to the veteran rather than be sent back to the lender to reimburse. At the time of this recording, the funding fee for a VA IRRRL refinance is 0.5% of the loan amount. Be sure to double-check the present-day figure. At the time of this recording, the funding fee for a VA loan assumption is 0.5% of the loan amount. Be sure to double-check the present-day figure. On a joint VA loan where one or more of the borrowers is a civilian, the funding fee is a percentage of the veteran's portion of the loan amount, not the entire loan amount.